Energy stocks are down 5% over the past year, while the S&P 500 is up 15% or even 16% actually. Is it time to buy traditional energy stocks? Or are the markets right? Is the AI data center theme played out? And what about new energy stocks like Oklo? Are they worthless meme stocks or serious opportunities? At Curia, we're here to help. We find the smartest guys to tackle the toughest questions. And we've done that for everyone wondering about energy stocks today. My guest is Dr. Jeff Krimmel, founder of Krimmel Strategy Group. I'm going to basically ask Jeff how stock investors like you and me should be thinking about investing in energy. And I'm pretty sure he's going to give answers that are deep and rich in context and wisdom. So, Jeff, welcome.
Thank you so much for having me.
It is my pleasure, Jeff. And I will just let it slip that I first heard about you from some friends who were at a conference you spoke at. And they said, man, this guy is amazing. The room was packed. He was a captivating speaker. Let's just try to reach out to this guy and see if he'll write back. And you did. And you were a total gentleman. So I am delighted. I've heard some other podcasts you've been on. You speak very well about energy from really all angles and minus the ideology that is so often present in this space. It's a very ideological and political and ecologically connected topic, but you kind of push that to the side and focus on the science. And I respect that, Jeff.
Well, I appreciate it. And it's very flattering to hear. I have a ton of fun talking about energy publicly, doing it on stage or doing it privately or, here through webinars or calls like this. And it's a lot of fun. And it's a good reminder for me about how many folks are thinking deeply about what's happening in the world of energy and how valuable these more constructive conversations can be.
Super, super. Well, Jeff, for those who were not in that packed room with standing room only, what is your background?
My education is all in mechanical engineering. I have a bachelor's, a master's, and a PhD all in mechanical engineering. And when I got my PhD, I went straight into research and development at Baker Hughes in the upstream oilfield service space. And I had a proper R&D engineering role, and that lasted for about a year before I got selected to participate in a leadership development program. And it was through that program that I got carried into some data-driven pricing and profitability work. And then that translated to some strategic market intelligence work. And that's pretty much what I've spent most of my 15 years or so in energy at this point is around the commercial excellence piece, around the market intelligence, and more broadly corporate strategy. So I started within upstream oilfield services and started paying attention to that space, and then E&Ps. And then in the course of my career, moved over to the well servicing space, and then eventually picked up some work downstream and midstream and adjacent spaces like mining and water wastewater treatment. So a lot of the tools that I use, I've steered toward the energy and industrial sectors writ large.
To a rube like me, it sounds like you've worked in or analyzed just about every space there is in energy, which is pretty cool.
Yeah, it's a lot of fun. There's, the advantage of having the PhD is that I learned how to think very deeply about complex topics and to try to reason through answers starting from first principles. And so it's the way that I approach my energy and industrial research on the whole is to try to understand from first principles, how do these sectors perform and how many of those principles are shared across, again, the wider energy and industrial space. And there's a lot of mechanics that are very similar across these spaces. Of course, there's differences between them. But it's helpful because I think you can think more broadly and more widely and with greater applicability across these spaces if you try to organize some of the mental models that helps you understand what carries across these various spaces versus what's unique to each. And that's where I spend almost all of my time thinking and exploring.
I remember as a kid in high school math class, we would pester the teacher, like, when are we going to need to learn these, use these factorials? Like, kids, you don't go to school to learn, you go to school to learn how to learn. And so it's actually sort of true.
It's absolutely true. And, the beauty of this space is, so many of the most consequential players in the energy and industrial domain are publicly traded. So we get a lot of great operational and financial performance data, and you get the executive teams talking on earnings calls, and you get all the details and investor presentations. So you really do get a pretty interesting window into how these organizations function and how these teams are thinking about the challenges and opportunities in their space. And so for something as important as the global energy apparatus, to have that sort of visibility into what's happening and why it's happening is incredibly powerful.
Well, speaking of publicly traded stocks, and I'm going to try to bring up this XLE chart. This is just an ETF that I grabbed that happens to have a lot of traditional energy stocks in here. As I mentioned in the intro, this is down, what, 5 something percent in the past year, whereas the S&P is up almost 17%. What is your short answer to that question of who's right? Is it the market, or are there undervalued plays right now?
I'll give you the cop out, which is there's a bit of both, but I'll give you some more detail to make that answer a little more useful. When I stand on stage and give these talks, one of the things I do, and I'm largely talking to oil and gas audiences, is the first slide in almost every presentation I show walks through the global oil demand outlook to 2050. And I show what OPEC expects global oil demand to do out to 2050. I show what ExxonMobil expects. And then the third one, I can choose Bloomberg or the IEA or any number of other forecasts that show global oil demand rolling over. So the idea is OPEC has the most bullish forecast for global oil demand growth out to 2050. ExxonMobil's is the second most bullish. And then there's a handful of forecasts that show, again, demand rolling over. My point is, even if you buy the OPEC outlook to global oil demand out to 2050, if you do the math on that, they have global oil demand growing at a 0.6% compound annual growth rate from now to 2050. When you look back over the past 25 to 40 years, oil demand has grown at a 1.2% compound annual growth rate. If you take any sector of the global economy and you take its long-term growth rate and you cut it in half, you will see real structural changes within that industry. So you don't have to buy that oil and gas demand is even going to peak here in the near future, much less roll over. Even if you just buy what OPEC is sharing in terms of their outlook, you'd expect real structural changes to the oil and gas sector. How that manifests in stock prices is, and it's part of the story I tell in all the talks I give, that oil and gas investors now, what we don't need to do is say litigate all the differences between the various forecasts that we have. What we need to understand is that investors are aware that there's these different groups that are very highly resourced, that have a lot of visibility, and they're coming up with very different answers of what they expect global oil demand to look like as you get to 2050. So what that means is there's just enormous uncertainty about how these markets evolve from here. So as investors, what that means is a lot of these multiples get bid down because we just don't know what the longer term outlook will look like here. Investors are insisting on an enormous amount of capital discipline from the oil and gas sector writ large. So there's not nearly as much reward in the way of trying to, say, deploy dollars through CapEx back into these businesses. And so these businesses are trying to get as cash efficient as they can be so they can pay dividends, pursue share buybacks pretty aggressively. As a result, like you said, you've seen these stock prices come down because the outlook out to 2050 is so uncertain at this point. Now, that's the bit why, say multiples are getting compressed, why these valuations are coming down. But your second part of the question is exactly right. There are absolutely opportunities here because there are, say, oil and gas producers that are low cost. That part of the analysis I do is estimating their break-even oil prices. So they have low break-even oil prices. They have relatively large volumes of inventory. So no matter what happens to oil demand going forward, there are some oil and gas producers that are absolutely positioned to participate the whole way through and generate value the whole way through. And that's why you're seeing a bit of a reallocation here within the traditional energy space, that the most competitive names are still attractive because their assets will not get stranded over time, regardless of what happens to oil demand. But there's others with higher break-evens that are more vulnerable.
Can I press you to name any names on that?
Yeah, so EOG is the company that shows up all the time when we're looking at low break-even oil prices. They also have a nice inventory runway. They have one of the more aggressive cash transfer programs back to shareholders. So that's one that shows up. Occidental always shows up on the high end of the break-even oil price analysis. They are one of the few, though, whose break-even oil price is coming down over time. So they clearly have some corporate focus on trying to drive cost out of that organization. But they're already starting at such a higher cost profile than what we see for the EOGs. But those are two that show up on opposite ends of a lot of the spectrums that I look at. Super.
And I was just rifling through my files, and this is the German oil price prediction chart. I've got a couple like this that basically show it's sort of like the folly of price forecasting, or how hard it is. The analysts just keep saying, all right, well, let's just project it from here. Well, it keeps going up. Let's just project it from here. Let's just project it from here. And this is not the only one. There's an IEA one. Well, this is IEA, actually. I have a few saved like this. I guess my question is, are we not trying to predict the unpredictable, right? The investing in economics, and I guess oil as well, it's underneath a social science, right? It's human beings making decisions, and it has the veneer of mathematics. It has the veneer of being measurable, quantifiable, analyzable, but underneath, it's still human decisions. It's still politics. It's still OPEC. It's still, what some guy in Kansas is his job, what his job depends on, and how far he's going to drive in a day, right? How much stock do you place in predictions in the first place?
It's an excellent question. I know exactly the kinds of forecast charts that you're showing. I've looked at those myself. And yeah, long story short, I mean, if there was a reliable, robust algorithmic framework to predict oil prices, that would be known. And we would have these forecasts that actuals would effectively lie on top of the forecast, and we would have confirmation that we understand how these markets work. It is clear that in the aggregate, no, that there's not a whole lot of visibility into what happens with oil prices from here. At the same time, there are, when you dive deeply into the supply demand dynamics, particularly over the near term, you can get a sense of whether we're going to today, right? We're living in an oil surplus environment. And there's a lot of belief that will remain the case for some period of time through 2026, maybe through the totality of 2026. And then you get to a point, and I've done a bunch of this modeling that shows that the oil supply eventually plateaus. Oil demand does grow enough where it catches up, and then it runs ahead of oil supply. And that's when you will see a price signal that results, and that will compel more investment. You'll see stock prices move up. It's really, really tough to know exactly when that happens, the magnitude with which that happens. And so for folks to kind of invest with the idea that these forecasts are infallible, I think it's a poor decision to make.
Let me jump to the opposite end of the energy investing spectrum. A savvy investor friend of mine who used to manage $1 billion hedge fund, he didn't say Oklo was a scam, but he kind of said it was a notch or a notch and a half above being one. Like it's basically good at putting out press releases. You seem a bit more bullish. Why do you feel more bullish, and how confident are you in your bullishness on Oklo?
I would say I kind of straddle the fence on Oklo. I understand, it's something. In fact, in one of my research pieces from about this time last year, there was a short sale report on Oklo. Mm-hmm. And so I went through and studied the short sale report and wrote a bit in my analysis about, okay, it's important to understand, okay, what is the bear thesis around this type of technology? And it's what you'd expect, which is, that there's constant risk for schedule slips and for budget overruns. And with Oklo and with any advanced nuclear company, there is very much an all or nothing element to the bet, because one of the challenges with advanced nuclear is getting designs approved and getting the various permits and licenses in place.
Yep.
And there's a bunch of reason to believe that the Nuclear Regulatory Commission is not going to start approving willy-nilly a wide range of designs here. And so if you're investing in a company whose design ultimately does not get approved, then it's effectively dead on arrival at that point. So it's a situation where, each of the advanced nuclear companies has some claim about why their technology is unique and why they're best positioned to take advantage of this gold rush within nuclear, right? Where you don't have to overcome the intermittency challenges that you see with variable renewables. And, there's more runway around the supply chain of that. It's weather independent, all the rest. And so I think for each investor, you have to kind of make a decision around, do you think that Oklo is uniquely positioned within this advanced nuclear space to really win that kind of race? And if they are, the returns truly will be astronomical, because it's clear within the US, you're going to align, I think, around a very small number of approved designs, and you're going to try to build those out at scale. And while we have one design from Westinghouse on the large scale nuclear side, there's really no clear winner of what's going to happen in the advanced nuclear space and the SMR type space. And Oklo is one of the contenders there.
Got it. So at a minimum, you're not putting a large part of your portfolio in Oklo. Certainly be very interesting if what they're talking about can materialize, but we're a ways from there. Big question, Jeff. What do you think the most misunderstood thing about energy is right now?
I would say there's sort of two answers that immediately come to mind. One is the runway for oil and gas. I would say, relative to the consensus, I think that oil and gas has a longer runway at larger levels of production and consumption into the future than probably the median analyst would estimate. Part of that is just because of how quickly energy demand is going to grow globally, that you'll still have a lot of demand there. And there's a huge pull from the petrochemical space on liquid hydrocarbons. And so you'll see continued demand there. So I'm probably a little more bullish around oil and gas than the median investor would be. The other bit is, I would say, the piece around nuclear. I think a lot of people, high profile people, are throwing a lot of weight behind nuclear, and which is perfectly fine to do. It's an understood technology. It's delivered power for decades at this point. The challenge with nuclear is it's very slow to come together at scale. And to this point, it has been very expensive. And so if you view far enough out into the future, absolutely, I would expect nuclear to be a meaningful contributor to that. when we're talking energy and the energy conversation that's happening right now today, we're really talking about how do we meet this oncoming crush of energy demand through 2030, maybe through 2035. And there's really not a way for nuclear to participate all that meaningfully there. So then we have real conversations about how hard are we leaning into gas, how hard are we leaning into solar and into batteries and other sorts of energy storage. And that's pretty much the totality of the energy conversation that we're going to be having in the near term. So I think that energy investors are probably too quick to spend a whole bunch of time and financial capital trying to think through the nuclear element. There are smart people that are working on that and it needs to get resolved, but those will get resolved more in a decade plus type of time scale. Whereas we have a lot of near-term challenges that it's sort of gas, solar, and batteries that are going to be the heart of the conversation.
Yep. Well, very well said. So if I'm just beaming into the U.S. energy space and I think, oh, AI data centers, that's hot. Nuclear is going to be hot. Nuclear is cool again. It was uncool for a long time. Now it's cool. Yeah, great. But you're looking at a decade plus. These things, a Southern company brought one online recently, right? But that was the first one in like a bazillion years. And really, the power generation fleet in much of the U.S. in terms of baseload power is almost geriatric. Like if you look at the coal plants, I mean, my God, 70 years old, some of these things. And I'm sure if you use new technology, it'd be a lot more efficient, but nobody's going to let you build coal these days. I'm sidetracking, but my point being that nuclear is cool, but it's just not ready yet. And I'm guessing you would say gas or maybe a combined cycle would be the fastest way if I didn't have a captive nuke. If I had an AI data center and I want to get quick power, is that accurate?
Yeah, if you want dispatchability. Now, the challenge with gas that I've written a bunch about is that, particularly say the scale of a combined cycle facility where you need truly massive turbines, that market is dominated by GE Vernova, Mitsubishi Power, Siemens Energy, and all three of them have been clear. They're not being super aggressive about expanding their manufacturing footprints. So as a result, you're hearing more conversation about distributed power and behind the meter power, and where you can use smaller turbines or reciprocating engines to generate power from natural gas. But even those scenarios, it's not clear that a supply chain is fully built out that allows for you to have this huge wave of new gas power generation come on. It's one of the reasons why, say, politically and just popularly, there's a lot of momentum, say, now behind natural gas and nuclear for all the reasons that we understand. But what's interesting is even with a rollback of a lot of the federal incentives from the Inflation Reduction Act, when you look at what's getting deployed, solar and batteries is a huge wave of developments ongoing there. And I think a lot of natural gas manufacturers are trying to pay attention to, okay, now that some of these federal incentives are getting pulled back, are we going to see any material weakening in this solar and battery boom? So far, we have not. And so when I'm going forward, even though renewables are less in favor now than they were circa 24 months ago, say, there's a lot of reason to believe that the world could see a lot more solar, a lot more batteries, and strangely, perhaps some more simple cycle natural gas facilities rather than the combined cycle stuff that can act as sort of a peaker and backup to solar and batteries when you need more of the seasonal development there. So it's a different conversation than you hear about if you're paying a lot of attention to, say, what's coming out of the political class here in the U.S.
And at this point, solar and batteries, is that like legitimately cost competitive now?
Yes, particularly when you add, if you have a natural gas backup to it so that you then have kind of firmed it up, it is on par with, say, a natural gas combined cycle facility. It's on par, both of them, when you kind of project out in time, if you can get nuclear's cost down a little bit, you get to a point where all of them are more or less at cost parity. And so then it's less, say, any one technology just absolutely racing ahead and becoming so much more cost attractive than everything else. And it's more that each of these technologies or groups of technologies have different benefits in different contexts, and there'll be different developers and different capital providers that want to lean more into one than the other, and that will be more of the conversation around kind of how those ultimately end up getting deployed.
What grade, if you were giving a report card and giving a grade, would you give the U.S. power grid?
Man, that's a great question. So if I were to give a grade right now, I would probably give it a C+, say. And I say that because my personal belief, having studied the power system to the extent that I have, is that we almost, I'll exaggerate for a fact, we almost criminally underutilize the grid that we have. There are so many smart technologies that would allow us to drive up utilization in the grids that we have. There are so many demand control elements that if our utility structures were set up in a way where they were incentivized to lean in to some of this more variability on the demand side of things, we could get so much more out of the grid that we had and not have to build nearly as much in the way of new transmission. But so much of our system is built around expanding infrastructure and getting paid back for that infrastructure that we lean really, really hard into the infrastructure expansion bits of it when there's so much more we can do otherwise. So it's a grade that I would give because I just don't see the utility community or the regulatory community that's driving the utilities in a direction that we could use more from our grid. But if that regulatory posture changes, we could ramp up that grade in a hurry.
There's a surprising amount of ideology in grid matters, and that comes out in many different ways, at least in my experience.
It's exactly right. And it's one of those deals because the regulators typically are appointed by politicians, and the politicians are running on, energy platforms are, almost an element of the culture wars at this point in the United States. So when politicians tie themselves to particular energy programs, it's almost in a way it's signaling some sort of tribal affiliation with voters. And then it becomes really difficult once those politicians win and once they have to make their own appointments. And you have to grapple with the fact that these energy challenges that are facing us here require a pretty nuanced, nonpartisan, non-ideological solution that varies a lot by geography, it varies a lot by demographics, it varies a lot by what industries are playing where and what their demands and needs are. That sort of nuance and sophistication is really, really tough to layer on top of a political environment that's incredibly polarized, incredibly tribal. And unfortunately for the world of energy is now one of the front and center issues in those polarized discussions. So that part is certainly unfortunate.
Absolutely. I mean, just for someone watching who's very new to this space, one of the many challenges of the grid is there's a mismatch often in the U.S. between where power is created and where it's needed, and you got to get the power from A to B. And it would seem simple, but in practice, it's actually not always. Let me step back to the investing space here. So investing, as I mentioned, Jeff, is a social science, but it has this mathematical veneer. With energy, you've got that, and you can add politics and ideologies into this soup that determines prices. If you were just taking a bird's eye view, what sectors in your mind are most and least attractive from a purely economic perspective? And then once you superimpose that social science layer, does that distort the prices favorably or unfavorably? I mean, do you see bubbles or not as maybe a shorter way of saying that, or deeply undervalued areas besides oil, some of those companies you mentioned earlier?
I am drawn to utilities. I think that the energy side of this equation is very real. We need more energy and we need to deliver it to more places. And the utilities are incredibly well positioned to participate valuably there. So even though the utility sector, I think, is maybe the second strongest performing sector in the past year or something like that. So I understand there's been a run up there. But I do like that sector because no matter the particulars of how things evolve from here, we definitely need more power and we definitely need that power in more places. Where I start to get concerned is, say, on the tech side, on the data center owner side of this, is that I want to be very clear that and I'll go ahead and use the scary word, but we can try to be reasonable about how we talk about it here, is this notion of a bubble in AI and data centers and stuff. Any data center that gets built will get used. So I have no concern that we're going to start building out a bunch of data centers and they're going to be mothballed and decaying and who knows where parts of the US. That all of these data centers are going to get used. The demand for this compute is real. What I am curious about is the race on the technology side to deploy these things as aggressively as they are, coupled with the idea that it is still really difficult, I think, from what I've seen, to monetize all the value that's being created from AI today. Means there is a time lag in terms of the financial obligations that are being taken on to build these facilities in the first place and the value that needs to be captured to turn around and meet these financial obligations. So the data centers themselves, I can see scenarios where today's capital providers may not ultimately get a return on those investments. Maybe they end up having to take a wash, but then there's a secondary purchaser of those assets at some point. And once we have a monetization scheme that's robust and reliable and well understood in place, then that secondary purchaser of these assets can ultimately make an attractive economic return. So I am bullish around where the utilities sit because the energy is absolutely real and we need it. The actual technology companies that are deploying this capital today, that's where I'm most skeptical that they're going to get the return they need within the timescales that they need to justify it.
It's kind of like with hotels. They say the second person to own the hotel actually makes the money because the first guy spent all the money on this and that and learning what to do, what not to do.
I think there's an element to that, and so it's one of the reasons why I am not concerned that, say, this is just a malallocation of assets where we're just building the kinds of infrastructure that we simply don't need. We will absolutely use this infrastructure. We will be happy we have it. There's almost certainly more efficient ways to go about it, but I'm of the mindset that because there's such a crunch right now, I would rather err on the side of a larger build out you incur possibly a little more waste in order to ensure that you're building out with appropriate speed. I think all the stuff gets used in the long term, but I think there's some really interesting timeline misalignment that could exist between the obligations that folks are taking on now to build these data centers and the timescales on which they will capture the return from having built these data centers. That's one bit of the equation I'm paying some attention to.
So you be cautious there, it sounds like. Do you have a view on midstream MLPs? Years ago, I had a dividend stock newsletter, and they were one of my go-to favorites. And then the tax treatment changed a little bit, but I always felt they were kind of in a sweet regulatory spot. Like the closer you get to the end user, the more regulated the business becomes. They're kind of in the middle, but I just thought they punched a little above their weight. They're pretty cheap now. Do you have a view on that?
I love midstream operators in general. I think they're great assets. It's a space that I do study with some detail. They have, we don't have to go through it here, but they have some interesting commercial models in place that allows them some protection against the volatility that a lot of other energy companies get exposed to and have to grapple with in more expensive or more painful ways. And it's clear, I've spoken to a conference, been attended a lot of these discussions where, say, the nature of the Permian Basin is going to change over time as you have this LNG footprint that's continuing to grow and expand here on the Gulf Coast. And then if we do have, a wave of natural gas generation to power, AI data centers, there's going to be a greater call on natural gas. And so it's clear that the egress situation coming out of the Permian in particular, but possibly even the Northeast, starts to change a bit as we become more gas focused. And I think that positions midstream players to participate well there. A lot of these midstream operators also are either already are or getting more heavily involved on the water side because there's a lot of water handling and treatment and disposal issues. Those only become more substantial as these fields mature. So all of this midstream fluids handling space is a space that I am bullish on.
And they paid big dividends for those who like dividends. And this is going to sound horribly offensive, and I'm just praying there's no CEO of a midstream company watching this, but it was either Warren Buffett or Peter Lynch who said, buy a business that can be run by monkeys because eventually it will be. And I know this is uninformed, but they always struck me as very simplistic businesses. You buy these pipelines and every now and then you have to make big decisions, but it's not like being the Gap or some fashion company where you're constantly making decisions day to day, guessing fashion trends, things like that. Like it's more like a few big decisions and just sit tight. So it's kind of a simple business model, and I always dig that.
Yeah, it's well understood. It's, where there is some innovation, it's largely on the commercial side of trying to understand how to buy and sell these hydrocarbons or how to set up the right tolling operations so that, you capture as much value as you can relative to the value that you're creating for this whole system. So there's real ingenuity and innovation around that. Like you said, there's high profile capital decisions that are chunky that get made in, specific windows of time. But I agree with you that the model of how to operate a truly excellent midstream entity is increasingly well known. And so as investors, it's a space that you can play with a bit more confidence, in my opinion.
So last question or two as we wrap up. So moving to almost the beyond Oklo end of the spectrum, are you a fan of private market investing for average Joes in energy? Some of these platforms that you jump into deals. I mean, I tend to think in general, a lot of the private market platforms are more consumption than investment. This is cool. I'm going to put $5,000 in this new ski wax, whatever. Should people be dabbling in energy, or are those deals mostly junk?
The real hesitation, not necessarily on the quality of the deals themselves, but the energy space and how it's evolving. There is so much uncertainty, and there's so much leverage against various political realities and various rapidly changing economic realities. Like we were saying, say what's happening to the supply chain on the natural gas genset side. There are just so many moving parts that are going to determine how our energy footprint ultimately gets built out and expanded and maintained over time, that just for a casual investor, I think it's a really heavy lift to try to wrap your arms around that to a degree that you would feel confident deploying capital into those domains. That's more my hesitation than say, I'm sure there are great deals to be done out there. I think the homework to get yourself to that point is substantial.
Got it. So if I'm interested in this conversation, I say, hey, I want to allocate some chunk of my portfolio to energy. One option would be to buy an ETF or one or two ETFs. What would you say, and this maybe is an unfair question, it's so broad and probably difficult, but like, what are a few building blocks that you might personally look at? And I'll caveat this with nothing we say here is any kind of official recommendation to anybody. This is just conjecture and opinion.
Yes, I would say, if you're willing to do some homework, I think one area where you can get where the returns to doing that homework can be a little stronger, say the exploration and production space, the E&P space that we mentioned earlier, that you can go through and take a look at these operators. Warren Buffett, right, is famous for saying he doesn't invest in things he doesn't understand, and he chose to invest in Occidental Petroleum. Yep. So it's something where, and he doesn't have a deep oil and gas background. And so these oil and gas producers are companies that you can understand with comparatively little homework. And so within the E&P domain, like I reference EOG because it has such a low and attractive break-even oil price, but there's a bunch of metrics you can go through and study and try to get a sense of which of the oil and gas producers seems to be most favorably positioned relative to what you're looking for. Likewise, on the midstream side, absolutely, there's some big midstream players that, like you said about the stability of their dividend programs, and you can look at their financial performance and the stability and resilience that exist there and develop some real confidence that if you have a well-capitalized midstream player, they're really in position to bob and weave with any sort of evolution that you would expect through that space. And there's actually opportunities in the petroleum refining space as well that liquids demands is still robust, and if you're looking for kind of shorter term investment opportunities, that there's some big independent petroleum refiners in the U.S. that could be worth exploring, and you can develop some confidence quickly that it'd be worth at least a short to maybe medium term investment there. So there are real opportunities in the public markets in each of those spaces.
Very, very helpful. Jeff, if someone's watching this saying, wow, this guy is cool, and I missed that opportunity to hear him speak at whatever conference that was, but I would like more of Jeff Krimmel, where would you send that person to?
Two ways. One, you can go to my company's Krimmel Strategy Group. You can go to krimmelsg.com. There's a link there for free newsletter. If you sign up for that newsletter, you'll see everything that I'm writing and doing and speaking, all the rest. The other way is go to LinkedIn and connect with me on LinkedIn. Just earlier this week, I crossed the 20,000 follower mark on LinkedIn. And so I wrote a post thanking everyone that follows me there. So the idea of following me there, it's a lot of fun because, I post stuff, and then a lot of high profile people end up having, putting some really interesting comments on the back. So if you're interested in a sort of ongoing, living, breathing, real-time energy conversation, if you follow me on LinkedIn, you'll see that there, and then the newsletter through my website.
We will put links to both of those in the box underneath this video. Jeff Krimmel, you clearly know your stuff. It was a pleasure to speak with you, and hopefully we can have you on again sometime. I think a lot of people are going to get a lot of value out of what you shared today.
Well, James, it was an absolute pleasure. I'm flattered and honored that you would have me on, and I'm already looking forward to when we can do it again.
Super, Jeff. Thanks again for joining us, and thanks to you guys for watching us at home.